Welcome to a live in-game update on the Slack trading desk. I want to discuss with you briefly my thoughts on price to earnings ratios, or the PE ratio. Now, I know they tell you at university and in textbooks that this is an important gauge of a company's fundamentals. I'll tell you, after 30 plus years of investing successfully for myself and for a myriad of private clients, I have never once used PE ratio to determine whether or not I should buy a stock. And here's the basic reason why. Technicals do not follow fundamentals. Stocks don't go up because of the fundamentals of the moment. And I know this is crazy. This is radical thinking. I get it. So try to wrap your head around this with me. Stocks go up because of liquidity. Stocks go up because of institutional flows of capital into the asset. So what we have to ask ourselves is, what gets institutions to put a lot of money into a stock? Okay? Analysts can write all day long about PE ratios, but what gets institutions to put money to work is future growth prospects. I spend all week on conference calls, on listening to earnings announcements, listening to analyst questions, right? I've been doing it for over 3 decades. Never once does an analyst come on and discuss the PE ratio. What they're always asking about is the future growth prospects, things that are happening inside the company that will blow out earnings. The E part of the PE. Okay? If you focused on PE, you would miss some of the greatest stock moves of all time. Amazon for years was losing money. So by definition, the PE was, impossible to calculate, right? For years, that stock skyrocketed as it lost money. And that's just one example. I could spend hours on this video with you going over past great winners, stocks that went up huge, and we would look at their PE ratio at the beginning. And if you cared about it, you'd miss all of those stocks. Okay? So this is about opportunity cost of money and investing in the highest grade names with the biggest performance going forward. Okay? And so our job is to find institutional flow of capital. That's what drives stocks, not the current PE. And here I'll give you just one last thought on why that is. Let's take the PE and then look at liquidity to see what makes sense. Price to earnings. Price to earnings. If the liquidity, and this is, you can think of this as if it was a bunch of boats at a dock in a harbor. Okay? Now listen to this, because this to me crystallizes it for me. I hope it does it for you when it comes to PE ratios. If you have an analyst who goes to the harbor every day and looks at how high the tide has risen, and you can see the tide mark on the dock, and then he comes back and tells everybody, these boats are only going to go this high because of the tide. He knows it. And for a while, he's right. So he has a PE ratio. You follow me? He looks at the tide and he says, that's as high as this stock can go. The price to its earnings will only go this high, and then it becomes overvalued. Okay? And he'll be right in a market, or in this case, when he's talking about how high the boats will go, and people will think he's brilliant, by the way. They'll say, hey, the boats only go this high. Oh, this guy's brilliant. He'll be brilliant for a little while, right? And then there'll be what we just had here in Florida, a king tide. Comes around every now and then. And the tide goes like this, and the boats go through the roof, and they come off of their moorings because the tide is enormous. And this guy misses all of those boats that went up. Okay, and now nobody cares what he has to say because he's been proven wrong, because the tide of liquidity, it's water coming into the marina, are you with me? Into the harbor. The water coming into the liquidity coming into the river, to the marina, has driven the asset, in this case, a boat, higher than anyone ever imagined. Okay, now take that analogy and look at stocks. If you want to argue that liquidity will remain the same for the rest of our lives, $1 trillion, just pulling that number out of a hat, a market size of $1 trillion, and that's all the liquidity there ever is, then I would submit to you PE ratios have validity, because the price to earnings ratios in a world where liquidity is stagnant will mean something. When they get too high, they can't go much higher. There's not enough liquidity to push them higher. But in the world we live in, we know we are, especially right now, in a world of infinite liquidity creation. Forget about a king tide. We're talking about a monsoon, a tsunami of liquidity. And if you're focused on PE ratios, you completely miss the point that there are more dollars chasing the same earnings today than they were chasing a week ago or a month ago. And this is what drives stocks higher. It's a liquidity question. The earnings today will be more valuable, even if they're flat, a month or two from now, if liquidity triples. So if you're stuck staring at PEs, you're looking at a static analysis. You're looking at the past, and you're not incorporating the most important piece of information in our world, and that's liquidity and how high the tide is rising, and vice versa. If liquidity shrinks, what looked like a good PE ratio a week ago will look like you paid too much for the stock a month or two from now. And it's because of liquidity. Okay? It's a common misconception that PEs drive stocks. They do not drive stocks. Liquidity drives stocks. I hope that was helpful, guys.